What really stands out to us is that the market has eluded extended periods of weakness because investors are bearish at the highs at a time when there's record cash on the sidelines. So to us, this is a market that is very skeptical of these new highs. That bearishness and concerns about tariffs means there's a wall of worry. So I think this is actually a very positive setup for stocks.
So you're not concerned about some of the data we've gotten? I mean, that University of Michigan consumer sentiment reading this morning in particular seems to have spooked investors, given the fact that it cited broad declines across age, income, wealth groups. You also said that big spike in year-ahead inflation expectations. That was unchanged, but the 5-year expectations moved higher, too. At what point does that start to manifest into something more meaningful in terms of a slowdown here in growth?
Well, these inflation expectation surveys matter to the Fed because they are concerned about whether or not consumers are actually raising their inflation expectations, and that would in fact be bad. But we have to keep in mind the UMich surveys do seem to be polluted by political affiliation. When you break down respondents by Democratic responses, they've gone from seeing inflation under 2% before the election to over 5% today. Republican respondents have gone from 4% to basically zero. In fact, if you look at the distribution of responses for those Democratic respondents, almost 7% think inflation is currently at 25%. So I think that there is a lot of pollution in that data, and I think it's probably pretty typical what happens when there is a change in administration, but I hope the Fed is aware of that political dynamic.
So Tom, if I recall, in Q4 last year, you were warning about market turbulence, and we've been right now at around S&P 6,000. We're at the level where we were a month ago, a month before that, in late November. Should we also expect turbulence at these levels at this point, given that the macro narrative and the political landscape is still unclear?
It certainly seems like it. I mean, I think investors can cite a lot of things top of mind why short term they're expecting the turbulence. You know, we're coming off 2 back-to-back 20% years. We know there's significant uncertainty about tariffs. In our latest client survey, 63% of our clients, and that's over almost 2,000 respondents, said tariffs or deportations is the biggest risk. That's up from 54% last month. But these are not things that have necessarily long-term negative effects. In fact, things like the number of Fed cuts is actually back towards 2. And I think there's a possibility the Fed may actually make cuts sooner. I think one thing the market is being complacent on is thinking the Fed's on hold. But if this turbulence causes hiring to slow, I actually think the Fed could actually be making cuts a lot sooner, which would be positive for stocks.
Okay, so tell me about these granny shots that you've got, you know, part of your investing strategy, some specific stocks, especially since growthy stocks seem to be especially vulnerable on days like today. And if we're going to get more volatility, it sounds like we might get more days like today.
Yeah, that's possible. But investors really want to own stocks that actually have structural advantages. And that's best evidenced by revenue growth, margin expansion, earnings growth, and reasonable prices. So the reason growth stocks will still outperform is that in a period like this, if we have macro uncertainty, they're going to be names with some visibility. It's not pleasant to own a growth stock today, but you know we know the lesson of 2025 is that these pullbacks have not been deep and investors have been buying these dips. So I don't think today is any different. In fact, it's no different than the DeepSeek panic or the tariff day panic or the CPI panic. So, I think this is going to be a buying.
The stock market continues to soar, with the S&P 500 reaching a new peak in late January and surging by more than 20% over the past year, as of this writing. However, between increasing political tension and concerns over the Federal Reserve's interest rate strategy this year, some investors are beginning to brace themselves for future volatility. Nearly 43% of U.S. investors are pessimistic about the market's future, according to a February 2025 survey from the American Association of Individual Investors, the highest rate in the last 12 months. While nobody knows what the rest of the year has in store for the stock market, longtime investor Warren Buffett has some timeless advice for handling periods of uncertainty. In 2008, in the thick of the Great Recession, Warren Buffett wrote a piece for the New York Times to help ease Americans' concerns about the future of the stock market. Buffett explained that despite all of the volatility, he was continuing to invest in stocks. A simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful. And most certainly, fear is now widespread, gripping even seasoned investors. He went on to explain that while it's normal to feel nervous about short-term turbulence, solid companies have fantastic long-term potential. These businesses will indeed suffer earnings hiccups, as they always have, he writes. But most major companies will be setting new profit records 5, 10, and 20 years from now. In the years following this piece's publication, the stock market has reached record high after record high. The S&P 500 has surged by a staggering 541% since October 2008. If you had invested $10,000 at that time, you'd have more than $64,000 by today. If a market downturn is on the horizon, the coming months or even years could be rocky. But history has proven time and time again that the market is capable of recovering from even the worst crashes and recessions, and those who stick it out for the long term will reap the biggest rewards. What you can do right now to prepare. Many investors' first inclination during a downturn is to sell their stocks and get out of the market. However, while it may sound counterintuitive, market slumps are one of the best opportunities to invest more. As stock prices reach record highs, right now is an incredibly expensive time to buy. If we face a downturn, it can be a fantastic opportunity to load up on quality investments for a fraction of the price. Again, in the early 1980s, the time to buy stocks was when inflation raged and the economy was in the tank. In short, bad news is an investor's best friend. It lets you buy a slice of America's future at a marked-down price. To be clear, it's only wise to invest if you have a solid emergency fund to cover at least 3 to 6 months' worth of expenses. That can help further protect your portfolio during a recession. But if you have spare cash to invest, now is the time to start researching stocks and deciding where you might want to buy if stock prices take a turn. Market volatility can be unnerving, so it's normal to feel worried about the future. But by reframing your outlook and focusing on the silver linings, your portfolio is far more likely to survive whatever the market throws at it.
The S&P 500 has advanced 71% since entering the current bull market in October 2022. Factors contributing to that upside include a resilient economy supported by strong consumer spending and business investments, which itself has led to strong corporate earnings growth in recent quarters. Some data points suggest the S&P 500 bull market will continue through 2025. In January, the manufacturing sector expanded for the first time in over 2 years, while the services sector expanded for the 56th consecutive month. Additionally, Wall Street expects S&P 500 companies to report accelerating growth in revenues and earnings this year. However, other data points suggest the bull market is losing momentum. Bearish sentiment in February 2025 reached its highest level since November 2023, according to the American Association of Individual Investors. Additionally, while inflation has trended lower over the last 3 years, consumer price increases have now accelerated in 4 straight months. Will the S&P 500 bull market end in a stock market crash in 2025? To elaborate, the S&P 500 traded at 3,577 when it entered the current bull market on October 12, 2022. If its performance aligns with the historical average, the index will advance 184% to 10,160 during the current bull market, implying 66% upside from its current level of 6,130. Additionally, history says the S&P 500 will realize those returns over 1,964 days. That means the current bull market will run for another 1,103 days if its duration aligns with the historical average, such that it ends in late February 2028. Here is the bottom line. History says the S&P 500 bull market could carry on for 3 more years, with the index increasing 66% over the next 1,103 days. That is roughly equivalent to a return of 18% annually. Importantly, the U.S. economy is on solid ground. Real gross domestic product, GDP, increased 2.8% in 2024, above the 10-year average of 2.5%. Additionally, the unemployment rate fell to 4% in January of 2025, which is well below the 10-year average of 4.7%. However, business fixed investments, spending on equipment, structures, and software, declined in the fourth quarter for the first time in nearly 2 years. Meanwhile, inflation has now accelerated in 4 straight months, which may weaken consumer spending. Those trends could drag on economic growth in the coming quarters. Additionally, the S&P 500 currently has a forward price-to-earnings PE ratio of 22.2. That is a premium to the 10-year average of 18.3 times forward earnings, according to FactSet Research. Elevated valuations could drag on the stock market by pushing investors to consider alternatives like fixed income. Indeed, the S&P 500 only achieved a forward PE ratio above 22 in 2 periods over the last 4 decades: the dot-com bubble in the late 1990s and the COVID-19 pandemic in the early 2020s. The stock market sold off sharply following both events,